Thank you. Good evening, participants, member of the Chartered Accountants of India. Sir, we are very fortunate to have to you in this 14th VCM virtual CPE meeting of the CPE committee being organized on external commercial borrowing and trade credits. So today we have CA Gaurang Gandhi as a faculty resource person on the topic. We are very fortunate to have him with us. CA Rakesh Saini Sahab, who is the moderator of today's session. Our chairman, sir, CA Dr. Rajkumar Dukia, he may also join at any point of time. So we would also, have him for his address. At same time, CA Ganchan Mishra ji, who is the vice chairman of the CP committee, we have also requested him, and he may also join at any point of time. So, sir, I am the secretary of the CP committee, Ajit Nath Tiwari. Welcome you to all the participants, faculty CA Gaurang Gandhi ji, moderator CA Rakesh Saini ji, who will take the proceeding of today's VCM, and in absentia, Dr. Rajkumar Dukia ji, CA Gyanchand Mishra ji. So, sir, on behalf of committee, to members, I would like to inform that this year CP committee, has undertaken various initiatives as far as the members' learnings are concerned. So, basically, we are focused that CP committee should provide the members, learning on various topics which are contemporary, some of the professional topics, as well as the non-traditional topics, like, IT related topics, other areas to become a global practitioner. So we are, keep sending, that information to the members also, so that to encourage them to become the faculty or moderator in our sessions. Also, we are encouraging this year to members so that they can become a writer, or they can revise our, already we have the certificate courses. So background materials, we are seeking the support from members so that they can revise those, background materials. And as per RCI policy, we have the suitable remuneration for them to these things. Same time, we would also request to members, basically this, VCMC is being telecasted, all across globe, not in India, but from, chartered accountants from abroad as well. So we would request to members, if they are at remote areas, as per action plan of our committee, this year we wanted to have more CPPUs, program organizing unit at official areas, where we can reach to the members who are, this point of time, they are not directly connected to our this learning system. Like, remote places where we want to open the CP study circle or chapter or groups. So again, as a committee of the secretary of this committee, I would request to members, so please you come forward and send us if you are interested to open the CPPU at your, that area as per the guidelines of the CP. So not, taking much time. Now I would like to request Rakesh Saini ji to please take over, this session and start the proceeding of today's session. Rakesh Saini ji, welcome. Please come.
Thank you, Ajit sir.
Welcome, sir.
Good evening, everyone. I am CA Rakesh Saini from Alwar, moderator of this VCM. We are delighted to welcome you all in the VCM being organized by CPE Committee of ICI. It is my pleasure to be a moderator for this session on external commercial borrowing and trade credits. In a short while, we will start this VCM. I would like to apprise you about CPE Committee. The profession of chartered accountancy has always been recognized for the quality of education, training, and strong grip over technical standards. With globalization and increasing business complexities, it is essential that chartered accountants equip themselves with the changes occurring and stand out to the expectation of society. Our institute is constantly working and contributing to cater to the needs and requirement of our members and has taken various initiatives for them from time to time in this direction. With this view, the continuing professional committee of ICI has always been the foremost to provide opportunity to their member to boost their knowledge base. The program for this evening is as follows. We have session on external commercial borrowing and trade credit. Our eminent speaker, CA Gaurang Vinod Chandra Gandhiji, will speak on the topic in a short while. I will introduce CA Gaurang Vinod Chandra Gandhiji. He is a chartered accountant. He has completed BCom, LLB, FCA, diploma in computer programming. He is practicing as a chartered accountant from January 1987, specializing in international tax, FEMA, corporate law, and investment banking. He is a fellow member of Institute of Chartered Accountant of India, member of Bombay Chartered Accountant Society, member of Chamber of Income Tax Consultant. He is a member of International Taxation Committee, BCS, and core group of BCS. He is author of Doing Business in India, co-author of FEMA and Taxation of Non-Residents, Exploring FEMA Edition 1 and 2, Exploring DTAA, a study on tax havens. He is visiting faculty for course on double tax avoidance agreement conducted by ICAI. He is speaker at seminar and study circle of ICI and other professional bodies in India and abroad. I welcome CA Gaurang Vinod Chandra Gandhi ji for his deliberation on today's topic. Welcome, sir.
Thank you. Thank you, Rakesh ji, for the kind words of introduction. We will go straight away to the external commercial borrowing and trade credits, and I will share my PPT for the members.
Gaurangi, I would like to inform to the participant, you just start your presentation as well. Meantime, sir, thus I am requesting to the participants, see, they may have some query on the topics, before of starting off, during the topic also. So we would request, please, you share your, queries in chat board of, that VCM board, where you are seeing this live chat, this thing, this VCM, so that we may, take up those questions, queries, and we may, provide to Gaurangji, so that, that reply can be given by them during the session or, after closing of the session as per the convenience. Thank you, sir. Thank you, Gaurangji. Please, you may please proceed.
Yeah, good evening, friends. Thank you for sparing time on a Saturday evening. The topics of today's topic, external commercial borrowing, trade credits, and structured obligations. I have divided the same into 3 parts for easy understanding. And I would request that as I progress, and if you have any queries, you can stop me in between and ask the queries, so that while we are discussing these topics, the queries can be solved itself, so we don't need to come back to the same slides again and again. Thank you. The first topic which we will be dealing in this evening's session is external commercial borrowings. External commercial borrowings, or ECB, are commercial loans which are raised by eligible resident entities from recognized non-resident entities. So whatever borrowings you are raising from non-resident will be treated as external commercial borrowing for FEMA purposes. Any borrowing from a domestic bank or an institution or an individual is not a ECB. It will be a domestic borrowing, while anything borrowed from outside India will be treated as a ECB. ECBs can be in foreign currency or in INR. Sometime back, up till say 3-4 years, RBI has now started permitting ECB in Indian rupees also, so that in case of foreign currency ECB, the exchange risk is on the borrower, while in the case of Indian rupee ECB, the exchange risk is on the lender. So this way, this is a major difference between borrowing in foreign currency and borrowing in Indian rupees. Sorry for my voice, I have got a very bad cold. ECB should conform to parameters such as minimum maturity, permitted and non-permitted uses, maximum all-in on a standalone basis. So if there are certain conditions which have been prescribed, say 5 conditions have been prescribed, then all the 5 conditions have to be satisfied at the same time. You cannot say I'm satisfying 4 out of 5, so it is okay. No, the means in totality, not on a standalone basis, means all have to be satisfied cumulatively and at the same time. What is the legal basis of raising ECB? Because as professionals, we will always want to know under what provision of the law ECB is falling. according to the master directions, ECB is covered by section 6 subsection 3 and clause D of Foreign Exchange Management Act 1999, that is FEMA 1999. Section 6(3)(b) covers the external commercial borrowing, and the ECB is regulated by Reserve Bank of India in consultation with the central government. As you are aware, FDI is regulated by central government in consultation with RBI. In the same manner, ECB is regulated by RBI in consultation with the central government. ECB is governed by the notification number FEMA 3R 2018-RB dated 17 December 2018 as amended from time to time. And as you are aware, previously when FEMA was introduced, the original series was without the word behind the circular notification. So originally it was FEMA 3. Now once it is revised in 18, they have made it 3R for easy remembrance and for content purposes. Then the government notification FEMA 8 also deals with guarantees and is also part of the ECB regulations. So when you are looking at ECB, you have to look at 3R as well as 8, so that there is no missing step or misconception in anything. And FED Master Direction 2018 dated March 26, 2019. So Master Direction number 5. This Master Direction, as you are all aware, is regularly updated by Reserve Bank of India. Whenever they issue a new notification or modify an existing notification, they come out with a master direction, and the original master direction gets updated from time to time. So this ECB and trade credit master direction is covered by Master Direction number 5, 2018-19, dated March 26, 2019. Before we proceed further, it would be better for us to know a certain important definitions.
Hello. Hello. Parth, Jay. Parth. Though he will join again or not? I'll ask him. Wait.
Sorry, I got disconnected. I'll share the screen again and we can start from where we stopped. Yeah. So, approval route is where, in case these cases are examined by Reserve Bank of India, prospective borrowers are required to send the request to RBI through the bankers. As you are aware, in most of the cases under FEMA, like FDI, ODI, everything, most of the time you have to go through the authorized banker, and the bank
पार्थ जी, आई थिंक उनकी नेटवर्क में कुछ इश्यू है, मैंने उनसे बात की थी। वो दोबारा ज्वाइन कर रहे हैं, एक सेकंड वेट कीजिए।
Can you hear?
Gaurangi would request you. I think there is some internet connectivity issue. So if you may please, off your video. Mr. Parth, you video from Gaurang this side, है ना? Gaurang sir, if you're listening to me, you may please stop your video and start screen sharing.
Screen sharing.
Yes, screen sharing, same time it's visible to us. So you stop video, start screen sharing only and audio. That may be a reason. That may be. Gaurangi, or you, it may be advised, you may please, kindly leave the meeting and again join the meeting without video.
Hello.
Yeah, your voice is audible, sir.
No, but screen you can see.
Sir, your video is only visible, sir.
Okay. So is it possible for you to do the screen sharing? I've sent the PPT because from the laptop I'm getting disconnected continuously.
Okay, sir.
Talking from the mobile now. I'm joined from the mobile.
Okay. Do you have the PPT? Sir, which mail ID you have sent it to us, sir?
I sent it on the WhatsApp group,
WhatsApp group. Okay. Could you resend it to us again? Mr. Krishna, would request you to please share here to Mr. Please share here to Mr. Parth so that Gaurangji may join through video and Mr. Parth same time, he can flow the, this PPT on his behalf.
Yeah.
Mr. Parth, मुझे टेक्स्ट बॉक्स में शेयर करना है क्या लिंक?
Now just Krishnakant, you requested here to share, or you can send it to Mr. Parth. Just Mr. Parth, you share your email ID or WhatsApp number. Audience, that members, we have some internet connectivity issue. In these time when we all are the things are on the virtual mode. Sometime we face a technical glitches, so it's a very so it's an inconvenience for you also. We understand, but we are trying to rectify it.
आपको भेज दिया मैंने. I'll send it.
Okay. तो आपने गूगल पे भेजा है, व्हाट्सएप ग्रुप में भेजा है, करेक्ट सर?
हाँ, व्हाट्सएप ग्रुप में से अभी उनको भेजा. Let us continue. We'll continue with the PPT.
Yes, sir.
Yeah.
Yes, sir. Right. You are visible, sir.
Yeah. Benchmark rate, any widely accepted interbank rate or ARR for 6 months tenor applicable in the currency of borrowing. So up till now, the Reserve Bank of India used to accept LIBOR as the bank rate. But as we are all aware, LIBOR is no longer a very valid rate on and from January 1st, 2022. So now RBI has suggested that you can use any other rate, which is an internationally accepted rate. So we can use the Mumbai interbank rate, or we can use American depository rate, or whatever rate is available. But generally, the preferred rate instead of LIBOR as of today is the secured overnight financing rate, or SOFR as it is popularly known. So now instead of LIBOR, people have started using SOFR. So when you are also negotiating with for ECB interest rates, you can use SOFR as the base rate and then add whatever is permitted by Reserve Bank of India. In case of rupee borrowings, the rate of interest will be the yield prevailing on government securities for the corresponding maturity. So for example, if you are borrowing for 10 years, then you have to see what is the corresponding rate for the 10-year government maturity, government securities, and then you will have to take that as a base rate, and then you can top up it with the permitted interest rate approved by Reserve Bank of India. As of today, the SOFR rate is around 2% for 6 months borrowings. So you can go up to say 5.5% plus 2%, up to 7.5%, 3.5%, whatever the rate the RBI is permitting over and above the SOFR rate. Then another important definition which has to be looked at is ECB liability equity ratio. This is very much important when you are borrowing from a shareholder. For the purpose of ECB liability equity ratio, ECB amount will include all outstanding amount of ECB other than INR dominated ECBs, and the proposed one only outstanding ECB in case of refinancing, while equity will include paid up capital and free reserves, including the premium received for the on the issue of the shares. So in case of ECB, what is permitted is free reserves, equity, as well as the share premium account. So that will be forming the part of the total liability equity ratio, and the ECB liability or the borrowing inclusive of the existing borrowings has to be taken as the ECB liability, and the issued capital, free reserves, and the share premium will be taken as the equity part, and then the ratio has to be taken out. both ECB and equity amount will be calculated with respect to the foreign equity holder. Where there is more than one foreign equity holder, the borrowing company, the portion of the share premium of the foreign lender only has to be taken into account. Say, for example, there are 3 overseas investors or who have invested under FDI in the borrowing company, and only one of the shareholder is lending. So then you have to take the share premium contributed by that lender only, and not all the 3 FDI investors in the company. That is what it means. So you have to be lender specific while calculating the equity premium. The ratio will be calculated as per the latest audited balance sheet. So generally,
your PPT also, because now your video is stable. So I think
okay, I'll try to log in again from the
yes, you please,
laptop.
you please try, sir, if it's possible.
Yeah.
Because it's better, because it's a synchronized when a speaker is talking about something and screen control is in his hand. So if that is possible,
We'll try. We'll see. There's no problem.
yes, sir.
Zoom link.
Recording in progress.
So we were discussing the ECB liability ratio. I think now we'll understand it properly for the purpose of
visible now, sir.
Yeah, for the purpose of ECB liability equity ratio, ECB amount will include all outstanding amount of the ECB, while equity will include the paid up capital and free reserves, including the share premium received from foreign currency as per the latest audited balance sheet. So we have to always see that it is the latest audited balance sheet and not an old one or unaudited balance sheet. Say, for example, you feel that you can borrow more by using December figures or September figures, and that is not permitted. You have to go by the statutorily audited balance sheet only. Both ECB and equity amounts will be calculated with respect to the foreign equity holder. There is more than one foreign equity holder in the borrowing company, the portion of the share premium of the foreign currency brought in by the lender, that is the shareholder who is giving the ECB, concern will only be considered for calculating the ratio. Then over here, the foreign equity holder means a direct foreign equity holder holding a minimum of 25% direct equity in the borrowing company. So the foreign investor should have invested more than 25% in the equity of the borrowing company, then only he can be a lender. And indirect equity holder means with a minimum indirect equity holding will be more than 51%, and group company with common parents is also considered as part of the equity holder. So these 3 scenarios are there when a foreign investor will be treated as a eligible lender for purposes of ECB. Now, what is the automatic route which we saw earlier, the definition? Under the automatic route, ECB up to 750 million or equivalent per financial year can be raised under the automatic route. So if you are raising equity up to 750 million US or its equivalent in any other foreign currency, then you can go under the automatic route. And also the debt equity liability, the ECB liability equity ratio is not applicable when the ECB is not raised in excess of 5 million. So up to 5 million US dollars, if you are raising ECB from your equity shareholder, then you need not go for that ratio checking, and otherwise, if it is more than $5 million, then the ECB liability equity ratio cannot exceed 7:1. So the liability cannot be more than 7 times the equity of the company if you are borrowing from a shareholder. All cases that are not covered by the automatic route will be under the approval route. An application automatic route or approval route has to be made in form ECB along with the required annexures. The annexures are generally the ECB agreement, the drawdown schedule, the repayment schedule, and the rate of interest. This rate of interest would generally be mentioned in the main agreement itself, but if you have not mentioned it, then you have to mention it in the as a separate schedule. Now, generally when we mean automatic route, we just feel that as we have to first receive the money and then make the application. No, but in case of ECB, even if it is under the automatic route, we will have to first apply to the a banker. The banker will get the registration number called the loan registration number, LRN, from the Reserve Bank of India, and once that number has been allotted to you, then only you can call for the funds. You can enter into the agreement and everything can be ready, but before the issue of the LRN, you cannot have a drawdown of the ECB. So even under the automatic route, before drawdown, you will still have to apply to the banker and get the LRN number, which is issued by Reserve Bank of India. Under the approval route, borrower has to approach the Reserve Bank for approval through their banker with an application in form ECB along with the required annexures. Same, everything is the same annexures: ECB agreement, drawdown schedule, and repayment schedule. And also, if you have not mentioned the periodicity of interest, then you should also have an interest payment schedule, which has to be annexed as part of the documents which are required to be filed. Then RBI will consider the application keeping in view the overall guidelines, macroeconomic situation, and merits of the proposal. So if you are otherwise ineligible, then the Reserve Bank may, even under the approval route, turn around and say, okay, we don't feel you are eligible because you will not be able to repay the ECB, or the interest rate may not be suitable to you. They can come out with reason and reject the application. ECB proposals received by RBI above a certain threshold are placed before the empowered committee, and the RBI will always consider the suggestions and comments of the empowered committee before they take a final decision. Final decision will always be of Reserve Bank of India, yes, but if the proposal exceeds a certain threshold, they will go to the empowered committee and obtain also their views and suggestions. Now let us see what are the provisions for ECB framework for borrowing in foreign currency. And generally the ECB guidelines are called as the ECB framework. So when you are looking at the master direction, you will come across the word ECB framework. So that's why I've used the same word, so that there is no confusion if somebody is looking at the master directions also. Currency of borrowing is any freely convertible foreign currency, and who can borrow? All eligible entities who are eligible to receive foreign direct investment. So if you are eligible to receive FDI, then you can also receive ECB. Then port trusts are specifically permitted, units in SEZ are specifically permitted, CDB is specifically permitted, and Exim Bank of India. So there are 5 types of entities or groups which can borrow under the ECB route or in foreign currency, and these are all entities eligible to receive FDI, then port trusts, units in SEZ, CDB, and Exim Bank. Now we saw the definition of all-in cost previously. So the all-in cost is for it is 500 basis points, that is 5 percentage points for new ECB. So if the SOFR rate is say 2%, then you can borrow at 7% maximum. That is what it means. The benchmark rate is benchmark rate plus 500 basis point means the benchmark rate is say 2.5, then it can go up to 7.5. If it is 1, then it can go up to 6. So that in case of new ECBs, in case of conversion of ECB interest rate from LIBOR to any other approved rate. So if in case the LIBOR was 0.5% for quite a long time or 1.5% for quite a long time, and now we are changing from LIBOR to SOFR, then you can go SOFR rate plus 5.5 percentage points, 550 basis points. So in case of new ECB, it is the rate, benchmark rate plus 5%. In case of a conversion from LIBOR to any other rate, it is repayment charge, penal interest, if any, for default or breach of covenants cannot be more than 2%. So this is, where you have to keep in mind that you cannot, juggle too much. Yes, juggling you can do, like the TDS you can bear, so that indirectly you are increasing the rate by 0.5% or whatever it is, the TDS rate, that much cushion you have. You can increase the interest rate indirectly by bearing the TDS. And hedging has to be done in case where guidelines require that hedging is a must, and in such cases you have to follow the guidelines as prescribed by the concerned sectoral or prudential regulator in the foreign currency exposure. So if your regulator requires that you should have a hedging, then hedging is a must. Otherwise, generally people don't do hedging because hedging itself entails a cost, and the cost is quite reasonably heavy when the foreign currency is fluctuating. ECB framework in Indian rupees. The currency of borrowing is, because it is in INR, it will be Indian rupee only. You cannot borrow in foreign currency. Who can borrow? All entities eligible to raise foreign currency ECB. Then registered entities engaged in microfinance activities with registered non-profit companies. Then registered societies, trusts, cooperatives, and non-government organization. So again, the list is quite reasonably big for people who can borrow in Indian rupees also. Even societies, trusts, cooperatives, etc. also covered if they are engaged in microfinance activities. All-in cost in this case will be the benchmark rate plus 4.5%. So if the if you have, say for example, borrowing for a 5-year period and the government security benchmark rate is 6%, then you can go up to 10.5%. If it is 5%, you can go up to 9.5%. Here again, TDS has to be can be borne by you. So indirectly, you can give a little more interest by bearing the TDS. Hedging by overseas investors, they are eligible to do the hedging in Indian when the exposure is in Indian rupees, and they are permitted to invest in derivative products issued by banks in India or by accessing the market through branches, subsidiaries of Indian banks abroad. So hedging is permitted when the foreign lender is exposing himself to rupee and to exchange fluctuation, because then by hedging he will be avoiding or at least reducing the risk of exchange fluctuation. Because in case of lending and borrowing in Indian rupees, it is the lender who is bearing the cost of exchange fluctuation. So hedging is permitted for them. Now, what are the different types of ECBs? It is a loan, including a bank loan, then floating fixed rate notes, bonds, debentures, other than fully and compulsorily convertible instruments. Because as you are all aware, fully and compulsorily convertible instruments are FDI instruments and not ECB. They are not debt instruments, they are equity instruments as far as SEMA is concerned. Then trade credit beyond 3 years, foreign currency convertible bonds, foreign currency exchangeable bonds, lease, financial lease, plain vanilla denominated bonds issued overseas, etc. What is prohibited is Indian banks, all India financial institutions and NBFCs cannot issue any guarantee in relating to ECB. So they cannot issue a guarantee with respect to the ECB, and financial intermediaries cannot invest in FCCBs and FCEBs. This is the only restriction which is applicable to ECB. Now let us see who can lend, means whom we can borrow from. As an Indian borrower, we can borrow from the resident of a FATF or IOSCO compliant country, including transfer of ECB. So if you are a resident of, say, Iran or North Korea, you cannot lend to a person in India because they are on the FATF blacklist. So you cannot borrow from them. But generally all other countries are and I think it's Sudan. So these three countries are on the FATF blacklist. Other than this, you can borrow from any other country, and there is no restriction as such. Multilateral regional financial institutions, where India is a member country, will also be considered as recognized lenders. So all this World Bank, Asian Development Bank, all these are also eligible institutions from which you can borrow. Then individuals who are foreign equity holders can also lend. As we saw, they should be holding a minimum of 25% equity in the company who is borrowing, in the borrowing entity. Individuals can subscribe to bond debentures listed abroad also. So in case of, this is specifically for FCEBs and FCCBs, they can subscribe to bonds, and foreign branches, subsidiaries of Indian banks are permitted as recognized lenders only for foreign currency ECB. Foreign branches and subsidiaries of Indian banks cannot invest in FCCBs and FCEBs, as we have seen in the earlier slide. Foreign branches, subsidiaries of Indian banks subject to applicable prudential norms can participate as arrangers, underwriters, market makers, traders for rupee denominated bond issued overseas. Underwriting by foreign branches, subsidiaries of Indian banks for issuers by Indian banks is not permitted. So when an Indian bank is borrowing overseas, then its subsidiary or a subsidiary of another Indian bank is not allowed to underwrite. Now, what is the minimum average maturity period? This is very important, because if it is crossing a certain threshold, it will be ECB. If it is not, then it may not. Then it may go to trade credit. So generally, the minimum average maturity period for ECB will be 3 years. And the call and put option also, which are mentioned in the agreement, will all come into effect only after the minimum maturity period of 3 years is over. So if you have a call and if say you have a ECB agreement where you are telling that the minimum maturity period is 5 years, but you have a put and call option that the company is not permitted, because the minimum maturity period has to be 3 years. And there are certain exceptional cases where a higher or a lower minimum average maturity period is prescribed. In case of ECB raised by manufacturing companies up to $50 million or its equivalent for financial year, the MAMP can be 1 year also. In case of ECB raised from foreign equity holders for working capital purposes, general corporate purposes, or for repayment of rupee loans, then the minimum maturity period has to be 5 years. It cannot be lower than 5 years. Then ECB raised for working capital or general corporate purposes or on lending by NBFCs, then it cannot be less than 10 years. So, and 10 years is the maximum permitted ECB so far. So it has to be up for minimum of 10 years. Then ECB raised for repayment of rupee loans availed domestically for capital expenditure on lending by NBFCs will again be the minimum maturity period will be 7 years. And ECB raised for repayment of rupee loans availed domestically for purposes other than capital expenditure or on lending by NBFCs will be 10 years. So basically it is 3 years, but under any of the ABCDE, then the minimum maturity period mentioned against each clause will be applicable to you. What can ECB not use for? Means there are certain restrictions. ECB cannot be used for real estate activities, investment in the capital markets, equity investment. So that is capital market will be secondary and equity investment will be primary. Then working capital purposes except specifically permitted, that is from when you are borrowing from the shareholders. Then general corporate purpose is again permitted only when you are borrowing from shareholders, and repayment of rupee loan when you are borrowing from shareholders or a NBFC is lending to you, and on lending to entities, this is permitted only to NBFC. So you cannot lend money or invest in the capital markets or invest in real estate when you are borrowing ECB. So it has to be used for basically business purposes only and not for speculation or for capital gains activities. What is the rate of exchange on and conversion? For conversion of rupee, exchange rate prevailing on the date of settlement. Say, so whenever you're receiving the ECB in foreign currency, then the rate of conversion will be the rate applicable on the date on which you have received the foreign currency ECB. In case of change of currency for ECB into Indian rupee, then the exchange rate prevailing on the date of the agreement for such change between the parties concerned, or at an exchange rate which is less than the rate prevailing on the date of the agreement if consented by the ECB lender. So generally, when you are borrowing, when you are converting foreign currency into ECB into Indian rupee ECB, then the rate of exchange will be the rate of exchange on the date of the agreement. Then change of currency from Indian rupee to any freely convertible foreign currency is not permitted. So if you have borrowed in Indian rupees, then you cannot convert the ECB into a foreign currency ECB. But say you have borrowed in a foreign currency and you want to convert into Indian rupees, that is permitted, but vice versa is not permitted. And change of currency of ECB from one freely convertible currency to another is also permitted, and it will be decided as per the negotiation between the borrower and the lender. Parking of the ECB funds. This is important because when you are borrowing, you may not immediately want to, use the fund. There may be a time lag between the use of the fund and the receipt of the fund and the use of the fund. ECBs can be parked either abroad or in India. Wherever you feel you have a better opportunity, you can file it. You can park it. Parking abroad. ECB proceeds meant for only for foreign currency expenditure can be parked abroad pending utilization in the following liquid assets: rated deposits or certificate of deposit or other products offered by bank, rated treasury bills and other monetary instruments of 1 year maturity, and deposits with foreign branches, subsidiaries of Indian banks abroad. Parking in India. ECB is meant for rupees expenditure must be immediately repatriated for credit to the borrower's rupee account with banks in India. The funds can be parked in unencumbered term deposits with banks in India for a maximum period of 12 months cumulatively. So in case of we are using for say import of machinery or import of raw material, you can park it overseas in the rated securities so that you don't lose on the exchange rate, because once you bring it to India, you'll have to convert to rupee, then again you'll have to, while remitting abroad, you'll convert into foreign currency. So both the conversion you may lose in terms of exchange rate and the bank charges. So to avoid that, you can park it overseas if you are going to use it for foreign currency expenditure. But if you are going to use it for only Indian rupee expenditure, then you cannot park it abroad. You will have to bring the money back to India. Now, is change in the terms of ECB permitted? Yes, it is very much permitted, and banks can approve any request from the borrowers for changes in respect of except FCCBs, FCEBs. And the changes can be change in the name of the borrower, lender, transfer of ECB and or other parameters if the change conditions comply with the extent ECB norms and are within the consent of and with the consent of the lenders. So you can change the terms of the ECB, including the rate of interest, provided that it is within the norms of the ECB as on the date of the change, and the lender and the borrower both have consented to it. So it cannot be a unilateral decision to change the terms of the ECB agreement. Both can jointly consent and mutually agree to change the conditions and terms of the ECB. Change of bank is possible only after obtaining NOC from the existing banker. So like ODI, you are stuck with a banker unless you take the permission from the banker, and that generally would not be forthcoming very easily. So after obtaining NOC, you can change, but there is practically that means it is difficult to change the banker. cancellation of LRN, possible if no drawdown against the said LRN has taken place and the monthly ECB2 returns till date in respect of the allotted LRN have been submitted. It is very important to note that the returns have to be submitted, as we will see in the subsequent slides. If the returns are not submitted on time, the penalties are quite heavy, and the Reserve Bank of India has levied penalties on many of the for delays in filing Form ECB2. Now, what happens in case of entities which are untraceable? Borrowers will be treated as untraceable entity if the entity, auditors, directors, promoters, or entity are not reachable or are not responsive or reply in the negative over email, letters, phones for a period of not less than 2 quarters with documented communication reminders numbering 6 or more. So in such cases, if the borrower is not responding, or if he is giving a negative reply, or the auditor is not giving his certificate, then the borrower can be treated as untraceable. And how will the Reserve Bank of India determine whether it is untraceable? Entity is not found to be operative at the registered office as per the records available with the bank. Entity not found to be operative during visit bank officials or any other agency authorized by Reserve Bank. An entity has not submitted statutory auditor's certificate for last 2 years or more, because in Form ECB as well as Form ECB2 requires the auditor's certificate. Case of ECB2, if you attach the certificate every once in annually, that is permitted. But in case of ECB, it has to be attached with each and every ECB application. So if the auditor's certificate is not attached, then it will be then the Reserve Bank will treat it that the entity is untraceable. If you have any queries up to this stage, we can solve it. Refinancing of existing ECB by fresh ECB is permitted, provided the outstanding maturity of the original borrowing is not reduced and the all-in cost of fresh ECB is lower than the all-in cost of the existing ECB. So you can refinance the ECB by rolling it over or taking a new ECB to pay off an existing ECB. Both are permitted. Then refinancing of ECB under the previous ECB framework may also be permitted, subject to additional ensuring that the borrower is eligible to raise ECB under the extant framework. Reserve Bank of India keeps on changing the requirements after a few years. So if you have borrowed under the earlier disposition and now you want to refinance under the current disposition, then you have to be eligible under the current disposition to borrow ECB. And if you are eligible to borrow, then you can refinance the ECB which has been borrowed under the earlier dispensation also. Raising of fresh ECB to refinance the existing ECB is also permitted, provided the borrower is eligible to raise ECB under the extant framework. So basically, you have to be eligible under the current law, current norms, and current guidelines to refinance the existing ECB. Indian banks are permitted to participate in refinancing of existing ECB only for higher rated corporates and for Maharatnas and Navratna PSUs. Otherwise, Indian banks are not permitted to refinance ECBs. One very important aspect is that many times after borrowing, for some reason, the business may not work out well and you may not be able to repay the ECB. In such cases, you have an option to convert the ECB into equity, and conversion can be full or part, means the full ECB can be converted into equity, or even partial conversion is permissible. That is, a part of the equity can be, part of the ECB can be converted into equity. And the following conditions need to be satisfied or complied with. Activity of the borrowing company is covered under the automatic route of FDI or the government approval route. Government approval is received if it is under the approval route. So basically, you should be eligible to take money under FDI. And the basic condition is this condition. I don't know, they have just mentioned, I don't know why they have mentioned, because if you are not eligible to borrow and if you are not eligible for FDI investment, then you are not even eligible to borrow ECB. That is the precondition for borrowing ECB, that you should be eligible for FDI. Maybe this is a very old condition coming where ECB and FDI were not linked. Then conversion must be with the lender's consent and without any additional cost. That means the lender cannot say that I will convert at a discount, or I will not pay I will convert at par and not at the present value of the equity share. So that is not permitted. It has to be done at the fair market valuation for issue of shares. Then conversion must not result in contravention of eligibility and breach of applicable sector caps of the foreign equity holding under the FDI policy. So it should be as per the norms under sectoral caps. Applicable pricing guidelines of shares are to comply with, as I said earlier, you have to comply with the guidelines for valuation guidelines for issue of shares under FDI policy. Then if the borrower has availed of any other credit facility from the banking system, then it has to take permission from that. Then applicable permission also has to be obtained, and prudential guidelines also issued by the Department of Banking Regulation of RBI has to be complied with. And consent of other lenders also, like they got other lenders other than banks, say financial institutions or corporate lenders, intercorporate deposits, then such lenders or creditors also, the permission will need to be taken before conversion of ECB into equity. A rate of action prevailing on the date of the agreement for such conversion or a lesser rate can be applied with a mutual agreement of the ECB lender. The fair market value of the shares issued must be worked out with reference to the date of conversion only, so that you cannot say the earlier rate was more favorable to the lender or the borrower. No, the date on which you are converting the ECB into equity, you have to do the fair market valuation on that date only and do the conversion. Security and guarantee to be issued for ECB borrowing. Banks are permitted to allow creation, cancellation of charge on immovable assets, movable assets, financial securities, and issue of corporate and or personal guarantees in favor of overseas lenders, security trustee to secure the ECB to be raised to be raised by the borrower in compliance with the extent ECB guidelines. There exists a security clause in the loan agreement requiring the ECB borrower to create charge. If there is no such clause in the ECB agreement, then no charge or security can be given to the lender. And NOC, if applicable, from the existing lenders in India has been obtained in case of creation of a charge. So personal guarantees by the directors, by the borrowers can be given, and they have to prudential guidelines, because if they borrow from the banking system, then they may have to obtain NOC from their existing banker, so that the guarantees are not the bank does not lose out on its guarantees. So this is taken care of by this clause stating that they have to obtain the NOC from the existing lenders. Can ECB be borrowed by entities who are under investigation? Yes, an entity against which investigation, adjudication, appeal by the law enforcing agencies for violation of any of the provisions of the regulations under FEMA pending can raise ECB as per the applicable norms if they are otherwise eligible. So if you are otherwise eligible to borrow, then only because some investigation is initiated or pending against you will not stop you from borrowing ECB. You can borrow ECB even if some investigation or adjudication or appeal is being enforced against you. The borrowing entity must inform about the pendency of such investigation and to the bank RBI as the case may be, and the bank RBI, while approving the proposal, will intimate the agency concerned by endorsing a copy of the approval letter. You can borrow under ECB. You inform the bank or RBI if it is under the approval route that you are under investigation, and RBI will or the bank will inform the concerned authority that this person, also under investigation, has been permitted to borrow ECB. entities under restructuring, refinancing, stressed assets. Now this is becoming a very important avenue because a lot of entities are going under a reconstruction and restructuring. So an entity which is under a restructuring scheme, corporate insolvency resolution process, can raise ECB only specifically permitted under the resolution plan. So if you want to borrow overseas to pay off your current lenders in India, then it should be part of the resolution scheme. Without that, it will not be, you will not be permitted to borrow ECB. Then eligible corporate borrowers who have availed rupee loans domestically for capital expenditure in manufacturing and infrastructure sector, and which have been classified as SMA2 or NPA, can avail ECB for repayment of these loans under any one-time settlement with lenders. And banks are permitted to sell through assignment such loans to eligible ECB lenders, provided the resultant ECB complies with
Hello. I think sir का network issue. अजय सर आपकी वॉइस भी नहीं आ रही है.
We will wait for some time. Let it come inside, sir. Meanwhile,
okay, sir.
Mr. Krishnan, could you give him a call? Mr. Parth, would request you to please share, screen. And Mr. Gaurang, he may, join from, his mobile. I think he has better connectivity with his mobile. And so, Gaurang ji, I am, requesting Mr. Parth to, share your screen, that, PPT screen. And you may also please, you please join to continue with your mobile. I think you have better connectivity as your mobile. Gaurang ji, is it okay with you?
Hello.
Mr. Parth. Mr. Parth, will you see the PPT? Okay.
Let's go to the next slide. Next slide. Yeah. Now, what are the reporting requirements for ECB loans? Monthly reporting of actual transactions. Borrowers are required to report actual ECB transactions through ECB2 return on a monthly basis so as to reach the concerned authority, that is the Reserve Bank of India in Mumbai, BKC, within 7 working days from the close of the month to which it relates. Now, this has to be done through the banker. So you have to reach it to the banker, say by the 3rd or the 4th or at least by 5th, so that they can forward it to Reserve Bank and so as to reach by 7th. Then change in terms and conditions of ECB, changes in ECB parameters in consonance with the ECB norms, including reduced repayment by mutual agreement between the lender and borrower, must be reported within 7 days to the Department of Statistics and Information Management (RBI) through revised form ECB. So in case of any change, you have to again file form ECB and then inform the banker accordingly. Changes in parameters also have to be incorporated in the ECB2 return. Now you have to keep in mind that it is not that you have received the first tranche of ECB, you have utilized it, and there is no now the second tranche is not received. The full utilization of the first tranche is over. Still, you have to continue to file form ECB2 every month until the loan is totally repaid. So until you have not repaid the loan and you have not utilized fully the ECB borrowings, you have to keep on continuing to file the ECB return month on month. If there is any delay or any gap, then you are liable to penalties. So even when you have not borrowed, say for example, you have signed the agreement in June and your first tranche of money is coming by August, still for June and July, you will be required to file the form ECB2. Otherwise, the Reserve Bank of India will levy penalty on you for non-filing. Then the reporting requirements in case of conversion of ECB into equity. In case of partial conversion, then converted portion is to be reported in form FCGPR, as well as the monthly reporting in form ECB2 also must contain the conversion details and must contain the words ECB partially converted into equity. And in case of full conversion, the words ECB fully converted into ECB equity has to be mentioned. And once the loan is fully repaid and utilized, then you need not file the ECB2 return. Otherwise, you have to continue to file the same. Now, what are the fees for late submission of ECB2 forms and ECB forms? In case of form ECB2, when the delay is up to 30 calendar days from the due date of submission, it is rupees 5,000. In case of ECB2 form ECB, up to 3 years from the due date of submission, that means after 30 days and before the 360 day, 3 years, it is 50,000 per year. And for ECB2 form and form ECB, after 3 years, it is 100,000 per year. So the penalties are quite heavy. And if you have not filed for 3-4 months, the penalty will go on become quite huge. And the Reserve Bank of India does recover the penalty. So it is not that, penalties will not be recovered. When the borrower, next slide. We are on 26. Sorry. Yeah. Borrower through its bank can pay the late fees by way of demand draft in favor of Reserve Bank of India or any other mode specified by Reserve Bank. Such payment must be accompanied by the requisite returns, and reporting contravention for ECB and form ECB returns will be treated separately. So if there are violations of ECB as well as ECB2, then both will be separate violations, and you will have to pay penalty for each of the forms. And even we have come across one client where they had borrowed 2 times, means ECB, they had 2 ECB loans, both 2 separate LRN numbers, and there was a delay in filing return for both, and they were required to pay the penalty in case of both the LRN numbers. So even if you have borrowed 2 loans and there is a delay, then it is not treated as one delay. It will be treated as 2 delays, and you have to pay the penalty for both the delays for both the LRN numbers. Non-payment of late submission fee will be treated as contravention of reporting provisions and shall be subject to compounding or adjudication. So if you are not paid the fees, then you will be liable to pay the go for compounding. And if the RBI upholds the fees, then the fees as well as the compounding penalty will have to be paid by you. Next slide. Next. Now, special dispensation in respect, above. Yeah. Special dispensation with respect to ECB by oil marketing companies, that is the OMCs. Overall ceiling for ECB shall be USD 10 billion or equivalent. Startups, then special dispensation for startups is limited to USD 3 million or equivalent per financial year, either in Indian rupee or convertible foreign currency, or a combination of both. All in cost mutually agreed between the borrower and the lender, and used for any expenditure in connection with the business of the borrower. So the restrictions are quite less, and a lot of freedom and free hand has been given to startups for using the money for the business purposes. CS certificate is needed in form ECB as well as form ECB2, and various components of all-in cost to be paid by the borrower without taking recourse to the drawdown of ECB. That is, the ECB proceeds cannot be used for repayment of interest and charges. So if you have to pay the interest and charges, you have to use separate funds, and you cannot dip into the ECB kitty to pay for the interest and charges. With this, we have come to the end of the ECB section, and we next, and now we'll be proceeding to the trade credit section. So if you have anything, we can still look at it, or at the end of, and also we can look at it, whatever is convenient to the participants. Trade credits. Now, trade credit refers to the credit extended by overseas suppliers, banks, financial institutions, and other permitted recognized lenders for maturity as prescribed in this framework. Trade credit can be for import of capital goods and for non-capital goods permissible under the foreign trade policy of the Government of India. Depending on the source of finance, trade credit includes suppliers credit and buyers credit from recognized lenders. Legal basis for trade credit is the same as the ECB, but apart from the ECB, what has to be looked at is the foreign trade policy of the Government of India. Because if you are not eligible to import the products under the foreign trade policy, then you cannot have trade credits against the same. So transaction on account of trade credits are governed by section 6(3)(d). Then it are regulated by RBI in consultation with central government. Then notification 3R and notification number 8 and a master direction number 5. So the master direction also contains this is a common direction containing both ECB and trade credits. Now, the definition of all-in cost under ECB and trade credit is a bit different. For trade credit, shall include interest, other fees, expenses, charges, guarantee fees, whether paid in foreign currency or Indian rupee, and withholding check taxes can be paid extra, and various components for all its costs to be paid by the borrower without taking recourse to the drawdown of TC. Proceeds cannot be used for payment of interest charges. And bank benchmark rate is again same in case of rupee denominated trade credit. The prevailing yield of the Government of India security for corresponding maturity, and for foreign currency denominated TC, it is generally the SOFR which is being used now. A trade credit framework for foreign currency. It can be in any freely convertible foreign currency, and the person who can take or borrow trade credit is person resident in India acting as an importer. So an importer is permitted to take trade credit. A unit or a developer, including the free trade and warehousing zone, as well as an entity in the DT. Next slide, please. Next. Yeah. Now, all-in cost ceiling per annum. Here, the spread is 300 basis points for new TCs, and for existing TCs which are converted from LIBOR to any other rate is 350. In the ECB framework, it was benchmark rate plus 500 and benchmark rate plus 550 respectively. Over here, it is 300 and 350. Hedging, TCs are required to follow the guidelines for hedging, just as in the case of ECB, they are also required to follow the hedging guidelines as prescribed by the regulator concerned. Next slide. Framework for Indian currency ECBs. The currency of borrowing will be Indian rupee. Who can borrow? Again, person resident in India acting as an importer. And then all-in cost ceiling is benchmark rate plus 250 basis points. Hedging is for overseas investors is eligible, just as in the case of ECB we saw, through derivative products or by accessing the domestic market. So hedging is done, and over here instead of 4.50, the benchmark rate plus 250 is applicable for ETC borrowings in Indian rupees. Next. Next. Amount of TC and who, previous one, 33. Amount of TC and who can lend. Amount of TCs under the automatic route, the importer can get trade credit up to $150 million or equivalent for import transaction for oil, gas refining and marketing, airline and shipping companies. For all other entities, it is up to $50 million or equivalent per import transaction. So the trade credit which importer can avail is for in case of airline, shipping, oil and gas, it is $150 million per import transaction, and for others it is $50 million per import transaction. Under approval route, it is there is no maximum limit. So if it is exceeding the $50 million or $150 million limit, then you have to go under the approval route where there is no upper limit. Who can lend? For suppliers credit, it is a supplier located outside India. For buyers credit, it is banks, financial institutions, foreign equity holders located outside India, and financial institutions in the IFSCs located in India. That is the gift city. So lending institutions, gift cities, as well as the overseas banks, institutions, and foreign equity holders can be lenders for buyers credit under the TC mechanism. Next. Credit period. Period of TC has to be reckoned from the date of shipment. For capital goods, up to 3 years from the date of shipment. For non-capital goods, up to 1 year or the operating cycle, whichever is less from the date of shipment. For shipyards, shipbuilders, for import of non-capital goods, up to 3 years from the date of shipment. For trade credit transactions related to SEZ, date of transfer of ownership of goods will be treated as a TC date or the trade credit date. So trade credit period has to be considered from the date of the shipment. So you may agree to purchase at any time, but the date of the shipment is important for calculating the number of days. And also it has to be kept in mind that if it is exceeding 3 years, then it will be treated as ECB and not a trade credit. Or if it is exceeding 1 year, in case of non-capital goods, then it will be treated as ECB and not trade credit, and you will have to go under the ECB guidelines and not under the trade credit guidelines. So you have to be very careful when you are drafting the agreements and planning the credits. Next. Rate of exchange and conversion. For conversion to rupee, exchange rate prevailing on the date of the settlement has to be taken into account. Same as in the case of ECB. Then change of currency for foreign currency TC into Indian currency TC. It is same again, exchange rate prevailing on the date of the agreement for such change between the parties concerned, or at an exchange rate which is less than the rate prevailing on the date of the agreement, which is consented to by the TC lender. Change of currency from INR to freely convertible foreign currency is not permitted, and change of currency from TC from one freely convertible currency to other is still permitted. This rate of exchange and conversion is practically similar to the rate of exchange and conversion in the ECB also. Next, what is a security which can be offered against a trade credit? By importer, security of movable assets, including financial assets, immovable assets, excluding land in assets, corporate or personal guarantee, or raising trade credit if there is a security clause in the loan agreement requiring the importer to create, then only you can give an NOC from the existing lenders. This is all practically similar to that is applicable to the security under Ecb. But one thing over here important is that the arrangement must be co-terminus with the underlying trade credit. So you cannot extend a security which is over and above the period of the trade credit. Say, for example, you got a trade credit for import of capital goods for 2 years, then the guarantee also should be co-terminus with the date of the trade credit only. You cannot give a guarantee for 2 years and 3 months. That is not permitted. And in case of invocation, payments towards guarantee should not exceed the dues towards the trade credit. So you cannot say, I incurred legal fees, I incurred this charge, I incurred this charge. That is not permitted. Only the outstanding amount is can be invoked and can be taken by the lender. Then creation, enforcement, invocation of charge must be as per the provisions of FEMA and must comply with the applicable FDI, FII, SEZ policy rules and guidelines. Because if it is not done, you will not be able to issue the shares or whatever is the other security which you have offered. Then banks, both Indian and foreign, can give guarantee against a trade credit, and guarantee may be given on behalf of the importer in favor, not exceeding the amount of the trade credit. And again, the period cannot be beyond the maximum permissible for trade credit. So you have to keep in mind that the trade credit should be co-terminus with the the guarantees and security should be co-terminus with the trade credit period only. It cannot exceed the trade credit period. Now, what are the reporting requirements for TC? Monthly reporting banks are required. In case of Ecb, it was the borrower supposed to report to the bank and bank in turn to Reserve Bank. Now, over here, the bank is only required to report and the borrower is not required to report. The banks are required to furnish details of trade credits by all its branches in a consolidated statement during a month in Form TC to the Director Division of International Trade and Finance, Department of Economic Policy, Reserve Bank of India. And quarterly reporting, banks are also required to furnish data on issuance of bank guarantees for TCs by all branches in a consolidated statement at quarterly intervals. So both the reporting by bank, once on a monthly basis and once on a quarterly basis. Over here, we must understand that the primary responsibility for compliance with the norms and regulations for trade credit as well as for Ecb is with the borrower. It is not with the bank or the Reserve Bank of India. So primary responsibility lies with the borrower, and if there is any violation, it will be the borrower who has to face the compounding penalty and not the bank or anybody else. And banks also expected to ensure that proper compliance with the applicable Ecb and TC guidelines are done by their constituents. So bank is responsible, but primary responsibility is of the borrower, and the banks will never be penalized for any lapse done by you or even any mistakes done by them. Because in many cases, what used to happen earlier, now it is not happening because of the awareness of knowledge. The banks used to, the borrower would invite the funds in the bank account, and the bank would also give the credit for the funds to the borrower without obtaining the LRN. And then when Reserve Bank of India said, then the borrowers used to many times say it was for the bank to say us no, that you cannot bring the funds to India without the LRN number, but the bank permitted and we used the fund. So then Reserve Bank said the primary responsibility is on the borrower, and the borrower will have to go for compounding, and compounding penalties were levied on the borrower. I didn't follow the question. What was the question which was raised just now? Somebody had raised a question.
Mr. Parth, can you check and inform?
Yes, sir. There are some questions. One of them is we borrow ECB for a period of 20 years from the foreign new shareholder of a company. Whether charge with MCA is required to be registered for ECB.
You are borrowing for 20 years.
Yes, sir.
No, you cannot borrow for 20 years under ECB. It has to be 10 years.
Sir, if the period is 10 years, then it is need to be registered with MCA.
Trade credit, I didn't follow the question. Can you put it on the screen?
Sir, it is on the chat box, sir.
Okay, on my mobile, I'm not able to open the chat
Okay,
box.
sir, I again read the question. We
Yeah.
borrow ECB for a period of 10 years
Yeah.
from the foreign new shareholder of a company.
Okay.
Whether charge with MCA is required to be registered for ECB.
Charge is required to be registered provided there is a if the person is creating a charge on the fixed assets or on debtors or something else, then it has to be registered with MCA. But if you are giving your equity shares, then there is no need to register the charge. It depends on what type of security you are offering to the ECB lender.
Okay, thank you, sir. Another question is, can an eligible borrower raise fresh foreign currency ECB for repayment of existing rupee denominated ECB?
Yes, if it is from the eligible lenders, that is, if it is from a shareholder, he can do that.
Okay. So next question is, trade credit initially taken for 1 year and later on renewed every year for more than 3 years. Does this need to be considered as TC or ECB? Please clarify.
ECB, because once it crosses 3 years, but then it will become ECB.
Okay, thank you, sir.
Yeah.
Sir, another question is on lending treated as capital for borrowers who are engaged in the business of on lending?
Yes. It will be treated as borrowed fund notes. NBFC will be borrowing either from India or from overseas. So it will be treated as a borrowed fund, and then they are permitted to on lend only, but on lending is permitted only to NBFCs, not to other companies.
Wrong disclosure of interest, principal repayment, and ECB2. What is the implication? Please clarify.
I didn't follow. What is wrong?
Wrong disclosure of interest, principal, repayment, and ECB2. What is implications?
You will have to revise the forms. No?
Is there any penal provision, sir?
Not as such. Generally, RBI does not levy penalty for such. If you find the original on time and you're revising only, but if this is a regular thing, then they will levy penalty. But if it's a one-off case, they generally don't levy penalty for rectification of mistakes.
Okay. Sir, can INR denominated ECB converted into foreign currency ECB?
No, that is not permitted.
Okay. Sir, another question is the debit balance in the profit and loss account for losses incurred by the eligible borrowers, if any, required to be deducted from the free reserve while calculating the ECB liability equity ratio?
Yes, they are required to be deducted, because otherwise how will you arrive at a free reserve?
Right. Sir, all the questions are answered. There are no more questions.
Okay, then we'll continue. Next slide. We'll look at the structured obligations. Now, structured obligations are, it's a modified way of modification to the original obligations, and a structured obligation to raise fund from the market. There are two types of structured obligations, basically non-resident guarantee for domestic fund-based and non-fund-based facilities, and facility for credit enhancement. Generally, structured obligations are when you have got an existing loan and you are trying to modify the terms and conditions so as to avoid a default. non-resident guarantee for domestic fund-based and non-fund-based facility. A non-resident parent will give guarantee for rupee facility, which is either fund-based or non-fund-based, such as letter of credit, guarantee, letter of undertaking, letter of comfort, or in the form of derivative contract obtained by its Indian subsidiary. So this form of guarantee is given by the parent in relation to the borrowings made by its subsidiary in India. No transaction involving foreign exchange will come into play until the guarantee is revoked and the non-resident guarantor is required to meet the liability of the guarantee. So until and unless there is an invocation of the guarantee, then there is nothing under FEMA which comes into play. But once the guarantee is invoked, then FEMA comes into play. Non-resident guarantor can discharge the liability by payment out of rupee balances held in India, or by remitting the funds to India, and by debit to the his FCNRB NRE account maintained with the bank in India. Go to the next slide, please. The non-resident guarantor may enforce his claim against the resident borrower to recover the amount, and on recovery, he may seek repatriation of the amount. So, the non-resident borrower, the non-resident guarantee giver can, once the guarantee is invoked, he will have to discharge his liability by payment out of the balances held in India, or by remitting funds if any held in India. And once he has paid off the Indian liability, he is eligible to take back the money from the original borrower, that is a subsidiary, and the subsidiary can resend the money overseas to the parent company in case the once the guarantee is being paid off by the parent. Next slide. Credit enhancement. Credit enhancement is a strategy for improving the credit risk profile of a business, usually for obtaining better terms for repaying its debt. Facility available to all eligible borrowers of ECB under the automatic route, and facility can be granted by eligible non-resident entities against domestic debt raised through issue of capital market instruments such as rupee denominated bonds and debentures. Underlying debt instrument must have a minimum average maturity of 3 years. Credit enhancements in short is basically like a ECB TC borrowing only, and repayment and call option can only after the average maturity of 3 years, and guarantee fees and costs included will be maximum restricted to % of the principal amount involved, just as in the case of ECB. On invocation of the credit enhancement, if the guarantor meets the liability and if the same is permissible to be repaid in foreign currency to the eligible non-resident entity, all-in cost as applicable to the relevant maturity period of the TC ECB is applicable to the novated loan. Novated loan, it means the new loan, the modified loan. In case of default, and if the loan is serviced in Indian rupees, the applicable rate of interest would be the coupon rate of the bond, or 250 basis point or 2.5% over the prevailing secondary market yield of 5 years of government India security as on the date of the novation, whichever is higher. And reporting arrangements are as applicable to the ECB norms. So in case of credit enhancement, basically you have to follow the guidelines which are applicable to ECB and TC. What are the other questions? I saw 2-3 questions flash on the screen. Mr. Parth, what are the other questions? Hello.
Sir, I think there is no other questions. You may please continue, sir. If there will be, of course, you will let you know.
Yeah, okay. Okay. No, I just saw 2-3 flashing by. Can SBLC be issued by AD banks on behalf of their customers for availing short-term trade finance from overseas lenders in foreign currency? Generally, Reserve Bank of India does not approve the issue of SBLCs, and the banks also generally will not be issuing SBLCs for again to foreigners for against trade credit or any other transaction. RBI does not generally appreciate SBLCs being issued. Then ECB money can be parked in a EFC account. Yes, ECB money can be parked in EFC account until the time you are actually utilizing that. But then you have to follow the EFC guidelines, which say that if you are not utilizing it in the month, then you have to transfer it again back to Indian rupees. So you have to follow the EFC guidelines, and that's why generally people prefer to keep it overseas. If they are to be spend the money overseas only, then they prefer to keep it overseas, because as per EFC guidelines, if you're not utilizing the money within 1 month, then you have to convert it into rupee and then again reconvert into foreign currency as and when you are going to use the money. Then what precaution has to be taken at the time of filing a form ECB in respect of an ECB? Precaution is that the form is very simple. And it requires all the contains all the details which has to be mentioned. But apart from the form, you have to again give the ECB agreement with it, the drawdown schedule, the repayment schedule, and the interest payment schedule. If it is not on a fixed basis, you have to give all these schedules also along with the ECB form. So there are 4 documents generally which go along with the form. That is the agreement, then drawdown schedule, repayment schedule, and the interest schedule. So these 4 agreement annexures are generally attached with the form ECB. Can ECB proceeds be used by eligible resident borrower for investment in their overseas JVWS as per the extent overseas investment guidelines? Generally, ECB proceeds cannot be used for investment. As we have seen earlier, investment is not permitted. So you cannot use ECB proceeds for investing in your overseas JV or WS. Yes, but the overseas JV and WS can borrow from theirs according to the law of the country in which they are located, and then they can borrow and then they can use the money for whatever purpose they want. But generally, ECB money cannot be used for investment in a JV or a WS overseas. Yes, LLPs are also eligible to raise ECBs. They can raise ECBs. There's no problem. ECBs are permitted from practically all countries except countries on the blacklist of the FATF, that is, which are listed. There are at presently 3 countries. One is North Korea, one is Iran, and one is Sudan. So apart from other than the 3, you can raise ECB from all countries. But like say for example, India does not permit you to raise ECB from Pakistan except with special permission. So you have to follow the guidelines. Otherwise, FATF compliant countries, you can raise ECB without any problem. So except these 3 countries in the world, North Korea, Iran, and Sudan, I think you can raise ECB from anywhere in the world. What precaution has to be taken before raising loan from non-resident? Non-resident means what? You are taking, is a shareholder or is not a shareholder? If he is a shareholder, then he should be holding 25% minimum in the equity. If he is not a shareholder, then and he is an individual, then he cannot lend under ECB. But if he is a non-resident and a bank or a financial institution, then he can give you ECB. You can borrow from ECB from that person. But means who is this non-resident? Is he individual? Is a corporate? What type of entity is a non-resident? individual. If the non-resident is an individual, then he has to be a shareholder in your company and he should be holding 25% equity in the company. I think I see the chairman of the committee, Dr. Adukya. I have finished my presentation, so if Dr. Adukya wants to add something or say something.
Yeah. Give me a minute, Goran bhai.
Yeah.
You can just tell them how to master FEMA. I want to take 2-3 minutes before I address. I am at a petrol pump.
Okay.
So
Don't
just
worry.
say how to master FEMA.
Master FEMA is basically, if you want to develop your practice in FEMA, the first thing you must do is, go to the RBI website, go to the foreign exchange drop down over there, and go to the notification and read all the notifications issued by Reserve Bank of India. Once you see the original notifications, then you should have a look at the master directions and the FAQs which they are issuing. Now they have stopped issuing FAQs, but there are still some FAQs which they keep on updating. So look at the FAQs, look at the master directions, look at the notifications, and then slowly try to understand and correlate all of them. And you have to continuously visit the Reserve Bank of India site to keep abreast of the changes which the Reserve Bank of India is bringing about. Because they don't announce all these changes. The only thing is they put it on the notifications screen. And there you have to go there and read it. And by regularly reading everything, you will get a good grasp of the law. FEMA is not that difficult. It is, but you have to keep abreast of the law. That is the only thing. And it is quite easy. And if you have any query and you write to Reserve Bank of India, they will be good enough to explain to you and give reply to your queries also. They are quite helpful that way. And now most of the things are done online. So you don't need to visit Reserve Bank of India. You can raise a query online and they reply to you online.
Thank you, Goran bhai.
And one last question, Rajkumar, then you can take over.
Yeah. Yes.
Can ECB's maturity period be reduced? If reduced below 3 years, will it be classified as TC? And in that case, what will happen to the all-in cost? Basically, once you have entered into an ECB agreement, as I've explained earlier, it has to be for a minimum maturity of 3 years. It cannot go below 3 years. If it goes below 3 years, then it is not permitted only because the bank will not allow you to repay the money earlier than 3 years. So it cannot go below 3 years. And if you want to borrowing for below 3 years, then you have to qualify for the TC. And you may not be qualifying for a TC if you are not an importer. So ECB cannot be for less than 3 years. Yeah, Rajkumar, thank you very much.
Yeah. Thank you, Goran bhai. Good evening, dear friends. Today is the 14th webinar of the CPEC. That means for the last 2.5 months, we have been doing 2 sessions every Saturday. And today, one faculty is taking both the session. The whole purpose of this webinar series is that each participant should take interest to become a speaker, to become a writer. The CPE committee and many of the other committees give 500 rupees per page if somebody write a book. So if somebody write 200 pages book, institute gives 1 lakh rupees. The conditions apply. It should be original work, research work, committee should accept it. Similarly, if somebody want to become a speaker, see how we develop in life. the one who is seen, there is a concept called thought leader. Thought leader is one who is seen by either writing or the address of that person. So when we look for a consultant in any subject, immediately to our mind, those names comes, those who have written articles, those who have written books, those who have spoken at the seminar. The CPE committee, under the secretaryship of Ajit Nath Tiwari ji, now there are two other officers, Madam Poonam Tyagi and Krishna Kant, are on this webinar. So I want each participant, there are 934 participants in today's webinar, that please be, when you make your goal, don't put any boundary, whether you will get a work in that area. The social media is one which is cheapest without spending any money. We reach out to 500 crore people of the world. 800 crore is the world's population. And be very aggressive. Use all platforms: Facebook, LinkedIn, Insta, Twitter, blog, YouTube channel, and write a book. And we will assist you. I will personally mentor you on whatever area you have selected. So this is the whole purpose of this webinar. From next week, we will be keeping a payment for the webinar, so that each one of you are serious, but you will be more serious once the money is paid. And we thank Rakesh ji, who volunteers to moderate many of our sessions. We want each one of you, because see, moderation is the easiest job, easiest task. And by compulsion, you will learn many things, because you have to read the resume of the faculties. So by reading, we feel, this person has achieved so much. Perhaps I can achieve more than that. So that comparison start getting built up. Plus, when you listen to the subject, you feel, this subject is so easy. I never looked at this subject. So over to you, Rakesh, to sum up and close the webinar.
Thank you, Rajkumar Adhikya sir. You give me such a wonderful opportunity, and I am improving myself day by day by learning such a new things in new way. Now I also thank you, Gaurang Gandhi sir, for such a wonderful deliberation and exploring new area of opportunity for our professional members. Thank you, Gaurang Gandhi sir.
Thank you.
Thank you, sir. Thank you from my side to all the participants. And I would like to inform to the participant that in spite of its busy schedule, Chairman sir, he has joined today to address this session. He is traveling now. In fact, initially I messaged to sir, and he informed me that, whenever it will be convenient for him, out of his busy schedule, he will take some time to address the participant. Chairman sir, I would like to inform. In fact, I was telling to the members, this year CP committee, set to, to do so many new things, like sir has already suggested to encourage members to become participant moderator, and we are also doing VCMs, webinars for the members. So sir, thank you very much, sir. We are very much sure, and that members will reach to the new heights in terms of learning, and committee will as well, as much as it is possible for the committee. Thank you, Chairman sir, for joining us. Gaurang sir also, on Sani to you also, and participant to you also, because today we have received very overwhelming response.
Ajit, we can mention about one more thing.
Yes, sir.
That in a district, there is no branch.
Yes, sir.
And 25 members can come forward and make a chapter. Like today, the Junjunu district is have started a new chapter. So I was yesterday branch, I Incurred branch, and perhaps I was thinking I'll be avoiding Junjunu, but everything happens twice.
Yes,
First
sir.
in the mind and then in reality.
Yes, sir.
So let us make our mind to do what we feel is impossible, unachievable.
Yes, sir. Yes, sir.
So thank you, CPC team, and
Thank you, sir.
many things to by members to come forward and participate in the CPC. I'm also heading another committee called Economic and Commercial Laws and Economic Advisory. So with this remark,
There is some behalf of Dr. Vice Chairman Sir Gyan Chand Mishra sir. I would like to thanks to participant, to Gaurang Gandhi also, to Sani ji also for moderating this session. Wonderful. Thank you, Rakesh ji.
Thank you. Thank you, Ajit sir. Thank you.